In today's video, we'll talk about current events, rising commodity prices, and more general items regarding investing for the rest of the year. Is the stock market broken? Don't buy the dip. Welcome back to Top Tech and Trades channel. Let's try to answer one of the biggest questions of the market. Why did the market just go up? Let's look at some market research from every single geopolitical event since the late 1800s to see what has happened in the past and perhaps what we can learn from it. The more we learn about the numbers underlying what's going on, the more it becomes clear why the market is poised to do the same thing. It'll do the exact opposite of what you expect. Home prices continue to grow at their quickest rate in history, even with oil at $100. Inflation is also expected to exceed 10%. This is a particularly challenging time for the economy, as well as the rest of the world. The conflict between Russia and Ukraine is extremely severe, and it's not something to be taken lightly. What we're seeing now is the conclusion of a long-running conflict between Russia and Ukraine that dates back to 1991. Following the fall of the communist-run Soviet Union, Ukraine had the world's third largest atomic arsenal at the time, and because of their near proximity to Russia to denuclearize and exchange security assurances that they would be safe from a Russian assault. However, under the rumored pressure of negotiating a deal with Russia instead, Ukraine's president abruptly rejected a deal that would have integrated their economy with the European Union in 2013. Although this was unpopular with the Ukrainian population, who began to demonstrate their dissatisfaction with the failed accord, Russia was concerned that their neighbor Ukraine would be forming a new Western ties. And so Russian troops seized control of a neighboring peninsula, igniting fears that they had broken a previous agreement not to fight. Given its location along the Black Sea's coast, it appears that Russia aims to expand its influence in the region. And if Ukraine were to further separate themselves politically, Russia's entire border would be controlled by an alliance that they see as a potential threat. As a result of the current invasion, a multitude of sanctions were imposed on Russia, including cutting off funding for US-owned debt, freezing assets within banks, halting certification of a natural gas pipeline, prohibiting the export of goods, enacting a travel ban, and potentially disconnecting from SWIFT, which processes payments around the world. All of this is done in an effort to push Russia to halt its advance and work towards a peaceful resolution. But in terms of the market impact throughout our economy, here's what we need to talk about. First, commodity prices such as oil, gas, and raw materials have surged but now reversing. Oil prices, for example, have risen to a high of $105 per barrel, with CNBC predicting that the price might rise to $130 in June if the current tensions hinder the crude oil supply. As a result, the US released over 50 million barrels of oil through the Strategic Petroleum Reserve, which has nearly 600 million barrels of oil, enough to replace about half of the country's imports for a year. The idea is to better stabilize the price of oil in the short term by utilizing these reserves. This is especially crucial given the fact that the US consumer is claimed to be the most affluent in the world. About 70% of the US economy is driven by it. And if prices rise, that will be a problem. Shipping, transportation, travel, consumer goods, and pretty much everything else we utilize on a daily basis all go up in price. However, some analysts also warn that commodity prices are inflated by as much as 40% and could fall a long way if and when concerns ease about the Russian invasion of Ukraine. They emphasize that commodity prices are rising due to market uncertainty, not because they are actually more expensive now, but rather because of an excess of caution. As a result, there's a swift chance that whenever things settle down, prices will drop just as swiftly. And second, As a result of the rising prices, the market is readjusted and lowered their expectation of an upcoming rate hike, causing in a sense the market to go back up. Consider this. The Federal Reserve is the central bank of the United States. In order to reduce inflation, the Fed is actively planning a rate hike on March 16. The faster prices rise, the more pressure they feel to hike rates faster than predicted, and the market falls as a result. However, the danger of an economic and global slowdown, economists now believe the Fed will need to modify and take things more slowly during uncertain times. The fear is that by raising rates too soon, they would damage the economy, might throw the market into a loop, and exacerbate economic volatility. But historically, it is worth mentioning that the market tends to underestimate the size and frequency of previous rate hikes, as you can see from this graph here. In 1999, 2004, 2015, and 2018, the Fed increased rates beyond what the market predicted. They actually admitted, however, that markets have been more sensitive to rate hikes than in the past, which implies they may have to be more cautious in the future, causing the market to rise. This is also why, the first time in 4 weeks, mortgage rates have begun to fall, even as home prices continue to rise by 15.4% year over year. Finally, we must discuss cryptocurrency before discussing why Wells Fargo advises against buying the plunge during the widespread liquidations at the onset of the invasion. Bitcoin plummeted below $35,000 in an unexpected turn of events. However, it began to recover almost as quickly as it had fallen, and it presently stands at around $38,000. According to some, this was due to the unwinding of short positions, which increased buying interest and pushed the price upward. The latest sell-offs, according to FTX founder Sam Bankman-Fried, are primarily driven by algorithmic investors who examine historical data and discover that Bitcoin has had a relatively high correlation with technology stocks in recent months, as investors expect the Federal Reserve to tighten its monetary policy aggressively. He also admits that as the war breaks out, people have less free cash, which contributes to sell-offs in Bitcoin and stocks. On the other hand, as Eastern European currencies become less stable, investors may turn to alternatives such as Bitcoin. Now, to address Wells Fargo's warning not to buy the dip. On the surface, the Wells Fargo head of global market strategy explains that it's just time to be patient as there's too much uncertainty. Furthermore, the more immediate concern for investors is what will happen with inflation, particularly if supply and demand balances in energy, aluminum, nickel, and fertilizers are disrupted. That spillover is the major concern for investors, with inflation running at 7.5% year over year. Is the statement, however, supported by the data? We'll start with an analysis posted by Morningstar 2 years ago, who looked at every single black swan event and war since the late 1800s. What they found was quite surprising. They measured the market in relation to what they called the pain index, which graphs the severity of each market crash as compared to the Great Depression. And they concluded that even though there are extended times of a flat market during extreme uncertainty, the best thing to do is to stay patient, because the market has always eventually recovered. Tom Lee of Fundstrat agrees, pointing out that the initial drop is frequently the best entry time, that US corporations have little exposure to Russia, and that stock price declines are attributable to fear and uncertainty, rather than any fundamental impact on earnings from the situation. Furthermore, CNBC noted how often corrections are, noting that 26 have occurred since World War II, with an average decrease of 13.7% over 4 months, which is similar to what we've seen so far. The S&P 500, for example, was down roughly 12% year-to-date at its lowest point, while the Nasdaq was down as much as 14%. Not to mention what we found out most unusual, the market sees an average return of 11% to 14%, with average inflation of 4.5% during times of war. which is largely attributed to the fact that once a war breaks out, uncertainty is removed and the market can begin looking forward. From the stock market perspective, even bad news is better than the unknown, and that tends to push prices higher like what we're seeing today. From a stock market perspective, it's always a good idea to keep buying in normally and understand that even though the stock market isn't always rational, uncertainty often leads to lower prices only because we don't know what's going to happen. So in my opinion, Wells Fargo is sending an irresponsible message to the majority of investors who are unable to time the market effectively and consistently. I feel it's probably smart to maintain buying the dip while also acknowledging that things could soon deteriorate. Nobody knows how long this will last or how bad it will be, and anything could happen at a time. So with that being said, always expect the best but prepare for the worst. Again, thank you for watching. Don't forget to hit the like and subscribe button. This is your Top Tech and Trades channel, and I'll see you in the next video.